Hello, friends. We're live. Welcome. Welcome. Good to see everyone. Mic check. Chat is rowdy. Smash the likes. Welcome. Good to see everybody. Let us go. Hello. Welcome, friends, to Alpha Beta Soup. I'm TXMC. It's February 15th, 2024. It's 11 a.m. U.S. Central Time. Hope you had a great Valentine's Day. I did take a week off from streaming last week. You have not missed anything. Had some personal things going on. Just couldn't make it fit in the time frame that I had given myself. But glad to see everyone here today. Got a few things to talk about. We'll try to fit it in a reasonable time frame. If you're hanging out in the chat, make sure you smash that like button. If you're already subscribed to the channel, that's great. Welcome. If you are not subscribed, I suggest you do that. Nothing you will hear today is financial advice. These are just the opinions of a singular man on the internet. I don't manage anyone's money, except my own. Take this as entertainment only. Since the last time we talked, which was February 1st, Bitcoin's up about 23%. It's at $52,000, which is incredible. The high was 52,829 here. This is on the index. Let me look on Coinbase. Coinbase, the high was 52,890 on Coinbase. And that was earlier today, actually. That was just a couple of hours ago. Pretty great run. Nice to see this. Some of this run started on the weekend, which is atypical. You know, we actually had was it this weekend? I'm remembering correctly, right? Yeah. There was a little bit of a run here. We actually pushed up a little bit here. So this is Saturday and Sunday candles, and we pushed up above the previous high on Sunday. And then, you know, obviously once the week started, we actually broke the previous ETF high, which is right here around 49,000. But now we're up here at 52,890. And that's very exciting. At the same time, we've been watching equities climb, right? Nasdaq's gone higher. There was a bit of a pullback the day before Valentine's Day, which reset a little bit of the progress, but it's been climbing nonetheless, right? And that's all very exciting, and that's great. And if you've been long this market during this uptrend, you've made a lot of money and your portfolio is worth more. Maybe you bought back during 2021 and 2020 near the highs, not in 2020, but 21. Maybe you bought near the highs and you've had some of your holdings in Bitcoin underwater for a long period of time, and now you're seeing them come back to break even, or maybe you're actually seeing green numbers. That's amazing. Congratulations to you, particularly if you acquired any BTC in basically the second half of 2022. You did quite well on your trade. You're up 2x on pretty much any position you would have acquired after 3AC collapsed. So good on you if you're one of those folks. The question now to ask ourselves is, how much higher can it go? I know that for many in the audience and on Twitter, the assumption is that this is the beginning of a new cycle, and we have much higher to go from here. We have many more green days and God candles ahead of us. And that could be true. But we also know that we have finally reached a really important retracement level, which is the 702, which is right smack dab in between the 618 and the 786. And really this entire range here, as we've talked about since as far back as late 2021, this entire range represents a really interesting place for any market, for any asset that is recovering from a downtrend, from a pullback. This is an area where typically the trend runs out of steam. Now, oftentimes, if you get above these levels and you see price reclaiming areas above the retracements, then it usually opens the door to return to the prior high, to the local high that started the move down. This same exact thing works in reverse. On a downtrend, usually the pullback only goes back about 70% of the move, right? Between 60 and 80% of the move. That's what these levels represent. And when I'm in my memory on this channel, I recall talking about these levels as far back as early January 2022. I had a video called Too Close to the Sun. And on there, I show the S&P, the Nasdaq, the Dow Jones, and we looked at Bitcoin to a degree, but we were talking about Fibonacci levels and retracements. Now for the equities, it represents an extension, which we'll look at here in a second, off of a multi-year cycle, off of a decade plus long cycle. For Bitcoin, we're looking at the retracement levels, which really have taken a long time to manifest. You know, I remember drawing fibs, and I'm not a fib expert, right? I'm still learning and going through a whole Bitcoin cycle for the first time myself. But I recall drawing fibs on BTC back here in January 2022 and watching as we only really did about a 40% bounce, which was really weak. Most of the time in a bear market, in a downturn with any real strength, particularly when it's a cyclical downturn and it's not just a pullback in an otherwise uptrend. But when you get a real downturn, a lot of times the bounces are much bigger than 38, 40%. Usually you get 60, 70% bounces, at least initially, right? I mean, that's what happened to BTC back here in the prior bear market. Right, you got a couple of bounces like that. They happen on smaller time frames. They don't happen over a year and a half. But right here, look, that's a bounce at the 702 perfectly, right there at the beginning of 2018. And you get those kind of moves a lot. And for BTC, it had a 618 retracement, but that didn't come until middle of 2019, right? So like a whole year and a half after the top of the market. And so we had kind of been waiting to just get our first one of these, right? In the 2017 market, I just gave you an example. There was one right here. There was a really sharp one right at the beginning of a retracement. But if we come back over here and we look at this side, we look at our current cycle, you know, this is the first one. This is the first visit above the 50% retracement. This move here. And, you know, we talked quite a bit when the ETFs launched. We talked about a lot on here about how this looked like a reversal. And those things were true. And I openly wondered if that meant it would be the actual top or if it would just mark a pivot point, we consolidate, and then we push higher again. Well, we've pushed higher again. We have our answer now, clearly. But this did look like a reversal, and it was into the 618 retracement, which is the same level that was hit back here at roughly the same kind of eyeball point in the cycle, right? The first real uptrend after the drawdown. And so it made sense to think, well, maybe it runs out of steam here. But as we've seen before, Bitcoin doesn't have to just make a peak, right? And then roll over. It can make a peak, pull back, and then do another little push higher. And that's not just a BTC thing, right? Maybe the same thing is happening to big tech right now, right? If you look at Microsoft, you look at Apple, you look at Google, some of these stocks are doing similar kind of prints of their own. And it's even leading to the Nasdaq kind of doing something similar to that on its own, right? It makes a high and then another new high. So will that play out over here? I don't know. I don't know if this is the beginning of something that, you know, breaks down more, that this is the last push up wherever this high is, right? Maybe it's this actual wick. Maybe it isn't. Maybe it goes even higher than that. Maybe it pushes up to the 786 before it rolls over. All of these are possible. There's no rule, and I certainly don't know. However, I think there is a strong possibility that we may be looking at the high for BTC very soon. And I don't think it will get to the all-time high if that's true, right? And if we go look at equities and we see what they've been doing, there's a lot of remarkable confluence here. Right? The same way we talk about the retracement levels on BTC and how important those are, there are extension levels, which are what happens when it goes above the prior high, right? And anyone who's really been watching me for a long time, or who's friends with my buddy BCB, he and I, we look at the market in similar ways these days. We talk a lot, and this is something that I've shown on my channel now for a couple of years. He's been showing it in much further detail on his channel, but we've now reached a 4.236 extension off of the tech bubble for the Nasdaq. It just hit it since we had our last stream. This is a level we've been looking at for a really long time. And like I said, we first started talking about the retracements and the extension levels in January of 2022. Nasdaq was over here, right? It did this whole dance in that meantime, waiting for us to get up and reach this point. I didn't know if we were on the way there at this moment in January 2022. I didn't know we would have this whole bear market and then come up here and touch it. I had no idea. But alas, here we are. And not only has the Nasdaq gotten there after the tech bubble, which when you measure this out from the low, that's 7,800 days. That's 21 years, right? I mean, I could have done the math myself, seeing the dates, but 21 years, right? The Dow Jones has done the same thing, almost, right? Almost, I think it's like 0.3% away, but in a much shorter frame of time. We're talking about 5,400 days. That's 15 years. It only went 500%. The Nasdaq's gone 2,200%, 2,100%. I think it's fascinating because then let's look at the S&P, right? That's the other major index if we're going to consider all three. Well, the S&P actually got there first. It was there in the summer, Q3, Q4 of 2021. It got there first. Now, a couple of things that I like to say about this. The first is that a fib level is not a gospel level always, particularly on an index, which is just a basket of a bunch of other stocks. You see it pretty often. It's more of a zone. You see respect at these levels. It's not always pixel perfect. It's one of those things where you kind of have to zoom out and see what price does on a structural high time frame basis around those levels. And that can take time to play out. That's not the kind of thing where you see it get to an interesting level at an index level, and then the pixel moment that it hits the penny spot you're looking for, that's supposed to catalyze some kind of a reversal or some change in the market. That isn't how I see it. However, what I think is interesting is the S&P got here much sooner than the other indexes, a few months sooner. And it did overextend beyond that, and is now extended a bit higher. But if we're just thinking about this in terms of a zone, it's really just been hanging out here and waiting for these other two to catch up because they weren't even close. And now they've actually gotten there. And the S&P is still within barking distance of its levels. It's actually been underperforming the Nasdaq considerably in order to allow, if we're thinking about it in terms of this playing out, in order to quote unquote allow the Nasdaq to catch the same extension level, because it was coming from a much further back point in time in history. It's been a much longer trek for the Nasdaq. Right? It started in 2000. The low was in the middle of 2002. The low for the S&P was in the Great Recession. That was in 2009, or 7 years later. But it got there much sooner just because of the weightings in the indices. Some of the names in the S&P pushed it up, and it reached this level relative to itself faster than the Nasdaq did, in part because the Nasdaq fell so much in the tech bubble. It fell 85%, whereas here the S&P only fell 55%, roughly. But I think it's interesting that the S&P has just been hanging around right near the top of this cyclical level that it reached while the other two caught up. And they have caught up to these two different points within a few days of each other. Right? The Nasdaq just hit it a couple of days ago. The Dow is 0.3, 0.4% away. It could theoretically hit it any day now. Maybe it doesn't at all. But I think it's remarkable that this same style of measurement off of two different cyclical crashes reached the same extension point within the same relative time of the cycle, right? Don't think in such strict absolutes that you're violating a rule by them not hitting it on the same day or by them not perfectly matching the absolute penny level of the fib extension. I don't think those things are important. What's important is the high time frame structure, the respect on a cyclical basis of those levels, and the general timing of it. It's fascinating to me. All of those have hit while Bitcoin, which is in what I think is a retracement and not the beginning of a new cycle, is now at critical retracement levels, thanks in part to ETF hype really pumping it there. And it's finally at its first taste of retracement levels. For the first time in any of its bear market histories, never had a 50% bounce, and now it finally gets one. Now is when it gets it. Here, this is when Bitcoin is finally at its retracements. It's a fascinating time. It's really hard to put the narratives away for people, and I understand that. It's hard to just take the chart on the merits of the chart. And I think that it's really important to be able to compartmentalize different frames of thought around the market. If you can separate them out and think about the chart just in terms of the chart, and think about the narratives about the market, the ETFs, the halving, retail buying, the US debasement, the deficits, like those are narratives. Some of them have mechanical components to them, but they are largely stories we tell ourselves about what's going to happen and how it's going to play out, right? They're the context we apply to the market. If you can separate those in your mind, you can often come to really interesting observations. And I think that this is one that cannot be dismissed or ignored. A lot of people don't think fibs are worth anything. I think it's because they just don't use them very properly, or they're being too strict in their deployment of them. But it's just hard for me to turn away from all of these things lining up during a period in which we think there's a high probability of some kind of a recession or economic slowdown manifesting. That's what we've talked on this channel, even more than the technicals, right? We've been talking, at least since last summer, at length about the probability of a recession based on data, right? It's not based on my feelings. It's based on the rates of change of a host of components of the economy, right? We've looked at cyclical measures, real manufacturing and retail sales, industrial production. We've looked at labor, right? We've looked at real incomes, demand, consumption, PCE. We've looked at inflation, credit growth, all of those things, housing market, the PMIs, which is just a survey of business conditions. We've laid them all over on top of each other. And they have told us that this is a window, this window right now. I know I've been talking about it since the beginning of 2023, but this is the window, not a year ago. Now is the window of time when it is most probable that an economic slowdown manifests based on things that have already happened and the rate at which they've occurred. So when you have this recession thesis laid out over the economy, and then you see the Nasdaq on a technical basis reach this really interesting place that you as an analyst, I'm talking about myself here, has been watching for a couple of years, it finally gets there. And just within a couple of days, maybe, the Dow Jones, on a totally different trip of its own and a totally different time frame and a totally different relative amount of gains, has gotten to the same measurable spot, while, oh, by the way, the S&P, on a similar time frame but on a different relative amount of gains, has just been hanging around at that level the whole time, waiting for these two guys to catch up. It's just this is kind of one of those rare moments where like the hair stands up on the back of your neck when you look at all this stuff. At least for me, right? For someone who has my perspective. Now, a lot of people think, well, how could you find any reason to be bearish here? How could you find any reason to think that price is going to turn around? The ETFs are buying $500 million of Bitcoin a day. The US is running structural 7% deficits. It's an election year. The Treasury is clearly trying to pump the markets. Like whatever people say, and there's a certain amount of validity to all of those things. That doesn't change what the chart shows, and the chart doesn't lie, right? You can go back in time, and there was a story that you could tell yourself about every single moment in time, every single era. There was some new technology. There was some fundamental component about the government or about people's lives that folks felt were different. And there were some elements of truth to that. But alas, the market continued to unfold in a very range-like, or not range-like, in a very consistent fractal way. That's the word I was looking for, in a fractal way. And that's because the price of the market, the price of all things, already includes all of that other information. You don't need to look at the price of the market and then also go, oh, and by the way, it's all these other contextual data points on top of it that make what the market is saying feel wrong, right? You can just look at the market. You can look at the price of things and get an idea of people's opinions and what they think about all of that contextual information. Right now, animal spirits are raging. If anyone thinks that we are not at peak equity sentiment, I don't know what to tell them. This is very much toppy feel in the market, right? People don't believe there's any rational way that things could underperform in a year when we have all of this criteria, right? The deficits, the money printing, the fact that it's an election year, the fact that AI is going to change the world and bring this productivity boom, the fact that the ETFs are buying all this Bitcoin and there's only 21 million and like, oh, blah, 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 blah. But one of the examples that I use, and there are many, but one of the ones that I like to point out to people is that at this moment of time here, in late 2021, October, November, December of 2021, markets broadly slowed down and started rolling over while the Fed was still buying $100 billion a month in QE, while interest rates were still at zero. And I think that it's because the story started to change. Despite all these bullish narratives, despite the fact that crypto was going to change the world, right? Bitcoin had just hit an all-time high. Institutions are buying. The chain is quiet. No one is selling their Bitcoin. Institutions will defend price. 30K is the generational floor. Miners are diamond-handed hodlers like me. Despite all that stuff, Bitcoin crashed. Despite all that stuff, equities rolled over. Here is the top of equities. This is November 2021 on the Russell 2000. This is the same time that Bitcoin hit its all-time high. The Fed was still running QE full bore until down over here, until this moment here. And still the market found a way to structurally break down and begin a downtrend. Because despite all the narratives, the story can change in a heartbeat. That's because the narratives follow the price. The price contains all the known information and all the known opinions. And then we just come up with stories about it afterwards. So I hear you when you come at me with, but the institutions, how could you possibly be bearish? God, can you imagine being bearish here? Like whatever people say, oh, you must be sidelined and sad. I can't believe you've missed the generational bull run, all that stuff. I just simply come back to these same data points. All this stuff is weird. You can't tell me it's not. The Russell, I think, is another good example of how this is just an odd market condition. If we just look at the Russell, right? These are small caps. These represent some of the more growth sensitive aspects of the economy. Well, right now we have raging real GDP at like 3-4%. Small caps are getting their ass handed to them. And they're not even above their 50% retracement. We have this whole structure up here that maybe they revisit soon. Maybe we get a push up into it and we see a little bit of a bounce, but then that would be the Russell's first real taste of a retracement. What were we just talking about with Bitcoin? But small caps usually, when there is a recovery and you're beginning a new expansion, a new sustained trend that is healthy, that has broad participation, that is something that's going to last, small caps are a participant in that. All you need to do is look at the S&P and look at the Russell 2000 and go back to the 80s and look at every bear market, the bounce out of it, and look at the Russell versus the S&P. In all of those instances, the Russell, except for just a couple of them, the Russell outperforms in percentage terms off the lows. Because small caps, they're more sensitive to growth. They're also more sensitive to interest rates, and rates are higher here. And that's valid. But this represents 2,000 companies. They're not irrelevant. A lot of people say, yeah, well, if they were good companies, they would be larger. That isn't true for everyone, right? You could run the best toothpick company on earth, and you're not going to be a mega cap, right? You're still going to be a good business that is relatively small. There's a lot of different examples like that. Small business employs like 40% of America. It's responsible for like 20, 25% of GDP. And so when this market is down here and the S&P is above its prior all-time high, that is something wrong and weird. That is different and new. That represents a dynamic that has not been present in prior genesis of new expansions. They're the kind of dynamic that you see in a bear market rally, which is kind of a hard thing to say because what just happened in 2023 you can't really call that a bear market rally. People try to make that argument. I don't think that's a good argument. We made all-time highs. That's a huge rally. That's a bullish year. That's a bull market. But it doesn't mean that the cycle has turned for the better into the future. It means that we had a huge bullish uptrend in 2023. And so this is just a fascinating period of time here. And I think the timing of all of these things with the Nasdaq lining up the way it did, at the same time the Dow Jones got there in a totally different frame of time and percentage, while the S&P just kind of chopped around here and didn't get too far away, didn't just completely blow past it, but actually as recently as November was still below its own 4.236. Even more interesting. This is the Dow Jones over the Nasdaq. These two right here. Here's the Dow over the Nasdaq. This is just kind of an interesting chart to look at. This goes back to the 80s. What are the three bottoms on this chart? This March 2000. That is the peak of the tech bubble. January 2022. That was the high of the market until just a minute ago, until just a few days ago. And then now, maybe now, we're not quite there yet. But the last time we got to this level, we had a quick bounce, and that represented the bear market, right? This was 2022. The last time we had this right here, this was the collapse of the tech bubble. This was the great financial crisis. And it wasn't quite as much of a move here, in part because we were still recovering from the tech bubble. Like if you look at the Nasdaq back then, like the Nasdaq, when we got to the great financial crisis, it was way down here, right? Like it was way down from its peak from before, even though the S&P had recovered all the way back up and had made a new high. The Nasdaq was still decimated. And so the great financial crisis produced an uptrend, but it wasn't the same one as the tech bubble, but it represented a major bear market. We've now come back to this level. Is this level going to be support? Are we going to bounce here again the same way we did in 2021? Look at that candle. This is on a monthly chart. Look at that fucking candle right there. Are we going to do something similar when we touch this level? Because if so, that's a bear market. I don't know. But what's interesting is, like I said, the Nasdaq went 2,100% from the low. The Dow went 500% from the low. And we've gotten back to the exact same place again? Can you just for all of it to line up right now? I just got kind of chills, you know? Got goosebumps a little bit. Got a little bit of tinglies in the back of my mind. It's just hard to shake these things. I'm not trying to scare anybody. This isn't Tales from the Crypt. I'm just doing analysis on the market. I'm showing it to you, right? I'm not hiding anything. I don't have some secret information. There's no guarantee that X or Y has to play out in any kind of particular way just because it did before. It's just looking at the data and pointing out trends and patterns and asking questions. I think that's all you can do. And I have some really big questions that I don't have good answers for, not answers that make me feel good inside. And so it leads me to a place of being very cautious about the market. As people become more bullish, I am becoming more cautious. And with BTC, where it is, like it's at the retracements, and I have people screaming at me about what a fucking idiot I am, that I'm cautious here. And I just spent 34 minutes giving you a very lucid explanation for why I am cautious here. So if anyone thinks that I'm fear mongering or that this is for engagement, I got a bridge to sell you. If you think that I'm in a cash position, as some people claim, that I haven't been long BTC this whole time, you're wrong about that as well. I'm on this boat with you. I don't know where it's going. I don't know if I'm right. I've bought some puts on big tech for later this year in case some of it plays out to protect myself. But I don't want to sell my Bitcoin. Like, I don't want to just bail on my positions, because what if I'm wrong? I need to see something that actually spooks the market, or I need to see it structurally roll over, and it isn't doing that. So if it doesn't do that, I'm going to pretend that I'm wrong because I want to be wrong. If I am wrong, it means everybody makes money. If I'm right, it means a lot of people lose money. It means lost jobs. It means lost wealth. It means the destruction of retirements. I don't want that to happen. So I'm going to hope that I'm wrong, try to protect my downside, and hope that instead I'm just a big dummy and I actually get rich because everything goes up like in some crazy melt up. That's what I fucking hope happens. This chart is wild. The Dow over the Nasdaq. That's the tech bubble. That's the 2022 beginning of the bear, and we're right back. That's just nuts, man. It's just nuts. So let's keep talking a little more here. We had a CPI report that came out this week, right? The CPI report came out a little hot. It came out hotter than was expected. Where's Forex Factory? CPI came out, it was 0.3% month over month. It was expected to be 0.2. The year over year was 3.1. It was expected to be a 2 handle, a 2.9. if we look, how do I want to talk about this? So it's pretty clear that this was not a good CPI report for the Fed. There's been a lot of hand wringing about this report and what it means, people picking it apart. Oh, well, these things are up, but these things are down. It's still coming down on a headline basis, so there's still disinflation. Don't worry, guys, everything's fine. There's other people who are screaming that it's a nightmare, that this is the beginning of the second wave, inflation's going to double digits, it's the 1970s again. And those are the two takes. As traditional as ever, the two takes are on polar extremes, and both of them are kind of ridiculous. So here we are in the middle trying to make some sense of it. The truth is, the headline figure surprised to the upside, but it still came down. So CPI fell. That's a good thing. It fell less than people expected on a year-over-year basis, and that is a bad thing. If you look inside of the basket, there are pieces that are not good for the Fed because they represent a near-term reacceleration of certain small pieces in the basket. And some of those things are not trivial. So this is 3-month annualized rates of change on a bunch of different components of the CPI basket. The far left is everything, and it's different from the year-over-year number. So when you get the number, when you're told the CPI report number and it says 3.1%, that's a year-over-year figure, right? A 12-month rate of change. This is a 3-month rate of change projected as if it happened for a whole year. So it's just looking at it on a more near-term basis. That's how I like to look at things. 3-month rates of change annualized, 6-month rates annualized. This is 3-month annualized. All CPI is 2.8. That's lower than the 3.1 currently on the year over year. But look at the core basket here. Actually, let me limit this axis here because I'm going to chop off some of the energy stuff because it's just making it hard to see the others. Sorry, energy, you're going to get shafted. There we go. So here's core, right? Core removes energy and food. Those are the two most volatile pieces. Core reaccelerated to 3.9%. That's the highest rate of change on a 3-month annualized basis since June of last year, since 7 months ago. So core jumped back up. Core services, which takes out energy services, which is a lot of people's wages. Services jobs are very labor intensive. More so than goods jobs typically, and core service inflation tends to more closely align with incomes. Well, look at that. It jumped to 6.1% on a 3-month annualized rate. It reaccelerated above any level it had been at for the last 12 months or so. Median CPI jumped up, trimmed mean. These are just two pieces inside the basket. They kind of chop off some of the more volatile things on the outside and they create a new CPI basket in the middle. That accelerated. The median value of everything inside the CPI basket, that accelerated. Food jumped back up. Food at home, that's groceries, jumped back up. This is not a good report for the Fed. Medical care services, tuition, and childcare, they're combined, jumped back up. So we know that rent, services, rent of shelter, owner's equivalent rent, those things are lagging and they're above the Fed's target. But if we just ignore that and we still look at all these other things, that's not a good look for the Fed, right? It doesn't mean inflation's blowing out. It means that it is settling at a level that is above their target. And there are certain components in it that are being stubborn and are starting to reaccelerate, right? So what does that mean for the market? Well, as we've talked about a lot on here, the market has been trying to guess that the Fed was going to cut massively this year. We've looked at this table a few times. This is the table from the Fed Watch, which looks at the pricing of interest rates in the market, Fed funds futures. And when we've looked at this in the last couple of streams at the FOMCs in March and going forward, we've noted that interest rates being right here, up until just a couple of weeks ago, the probabilities for interest rate cuts at every single meeting this year, FOMC meets every 6 weeks, every single meeting this year, there was a 50% or better chance that there was going to be an interest rate cut if you asked the market. They thought the Fed was going to cut 25 bips every single meeting all year long. Well, the Fed said, they explicitly said when they released their projections in December, we're not going to cut that much. We're going to cut 75 basis points this year, roughly, like generally speaking. We're going to cut 75 basis points, which is loosely projected to be 3 meetings. 3 meetings, 25 bips each. Well, not 6 or 7 cuts of 25 bips each, which is what the market has been calling for. They've been just outright ignoring what the Fed said, even though the Fed has done everything they said they were going to do since the beginning of 2022. They've done everything they said they were going to do. They've actually gone out of their way to let the market know what they wanted to do. They've taken extra steps to ensure that their messaging is 100% clear and understood before they do something new, before they change a policy rate. They've gone out that since 2022, now 2 years of this. Yet the market doesn't want to believe them. It said, nope, you're going to cut 6, 7 fucking times. Well, what happened? We had FOMC at the end of January. We did a review on that last time on February 1st. We did an FOMC recap on here. You can go back and watch that if you want to see me break it down in detail. But the takeaway from it was that Powell said explicitly, we will not be cutting rates in March because the data doesn't support it. Something would have to change. We don't even know if we're going to cut in May. That might not be enough data for us. We're going to wait and reserve judgment. And the market just didn't care. And as recently as just a few days ago, it still projected a coin flip, though it had come down a little bit. It still projected loosely a coin flip chance of cuts at every meeting, including March. So the market just doesn't care. It does not believe in higher for longer. The market does not believe that the Fed is going to hold off on cutting as much as they want them to cut. But in the last few days, since the CPI report came out and we saw this acceleration and all these different components and it had time to be digested, the market now thinks there is only a 10% chance of a cut in March. Isn't that funny? Powell has done nothing but continue to reiterate the same messaging since December, and the market has gone all over the place, just yo-yoing around on expectations. First it was like 80%, then it was 50, then it was 60, then it was 40, now it's down to 10%. And I think that something similar could happen again in May. May's down to 61%. May's down to 61%. Or it's up to 35% chance that will have been cut by then. And so we'll see how this plays out. But I think it's kind of a fascinating moment because we're watching the end of zero interest rate policy and the convulsion of investors who don't believe that that is actually the truth. They believe that at any moment we're going to go right back to the same old Fed before COVID, before 2021 even. But what I have been saying, the message that I have maintained, my opinion, I don't know, right? I'm not trying to act like I know better than anyone. I certainly don't. I just have conviction in my views because I spend a lot of time on this. My messaging for this entire cycle has been, because inflation now exists in this cycle, the response function of the Fed will necessarily be delayed. They will not be eager to cut. They will try to hold on for longer. And that's because inflation is their number one nemesis. And even though it's coming down on a rate of change basis, the market's trying to get cute with it and saying, oh, well, you can just walk inflation down with the policy rate. And every time inflation comes down, you just cut interest rates that same amount. And then 6 months from now, we'll meet in the middle at 3%, 2%, and everything will be great. But Powell even said in the FOMC, that's not how it works. We can't just walk the policy rate down with the inflation rate. It doesn't work that way. It is a dynamic system. And we're measuring things on a lag in an imperfect way. So you can't do it like that. The market doesn't believe that, though. They continue to price those things. The data continues to support what Powell actually said. And then every couple of weeks, we have this convulsion and it goes, oh shit, we have to actually believe him now. Even though he's been telling the truth about interest rates for 2 years. Do you guys remember in June of 2022, right before the first 75 basis point hike, Nick Timros of the Wall Street Journal leaked a story about the Fed and how they weren't going to raise 50 bips. They were actually going to raise 75 bips. That's because the Fed went out of their way to leak that story so the market didn't get surprised, because inflation was still accelerating in 2022 at that moment in time, and the Fed decided they needed to do more than the 50 they had said before. So they leaked the story. They gave the market 36 hours to digest it, and when FOMC came out, lo and behold, it was 75, and Nikki Leaks was right. They have been going out of their way to try to tell the truth about what they think they're going to do and not to surprise the market. Forward guidance is a tool of theirs. It's not just the rates. Jawboning is a tool of the Fed, and they have been using it very effectively, I would say. But we're at this place now where, because inflation's kind of sticky, because Atlanta Fed GDP now, look at it. Atlanta Fed GDP now says 3%. Maybe it settles at 2.5%. That's above potential. That is above the potential, forecasted potential GDP of the country, which is like 2.5%. So if we have strong growth, labor is continually coming back into balance. We haven't seen it just blow out into like high unemployment. The rate of change is slowing down, and we know we have some concerns there. But from the Fed's perspective, that's going according to their plan. It's actually going better than their plan, because when you ask them what the unemployment rate was going to be, they thought it would be 4.1. Well, it's 40 basis points below that. It's like 3.7. So it's actually going better than they thought it would. So if that continues to be the case, the Fed is not going to feel any pressure at all to cut interest rates. And so if that's true, and they're going to hold out for a while longer than anyone really thinks, well then, boys and girls, we're starting to get back into that moment of time where we have to bring up our beautiful chart again. Because this is what the market thought they were going to get. And the market thought they were going to get this. The Fed said, it's actually more like you're going to get this. But if CPI continues to do what it's doing, maybe they only get like this. Maybe it's less. And the market needs this kind of cut in order to afford all the debt they got back here. And I mean, guys, you look at the stories. What's on the front page of Bloomberg today? Dozens of banks rapidly piled up commercial property loans. U.S. commercial real estate contagion is now moving to Europe. Warning signs from U.S. to Asia have multiplied recently. There are hundreds of billions of dollars of unprofitable assets or debts that are being held by assets that are no longer worth what they were when the loans were taken out. And many of those entities have been holding off. There's a phrase on the street: survive until 25. They're meaning 2025, meaning they think that if they can just hold out, the Fed will deliver the cuts. Well, it's starting to look less and less like that's the case, because inflation exists in this cycle, and the Fed does not want to look like Arthur Burns from the 1970s. It's a real pickle. It's a policy trap for them. And I pointed this out not that long ago. I've been trying to put all of my views on here so that when shit starts going awry, if it does, if I'm right, I can bring these back up to say, look, this is what we've been talking about. You can see this coming if we're right. This year is setting up as a potentially historic policy trap for the Fed, caught between the reawakening of their nemesis in inflation and the total arrest of credit markets due to the secular end of zero interest rate policy after far, far too long. Meaning, the Fed is stuck. Not meaning that inflation is reawakening in 2024 to be 10%, but inflation was here. 18 months ago, it was 9%. It has been here. The total arrest of credit markets due to the secular end of zero interest rate policy. No one wants to refinance. They're all holding out for cuts. And now losses are beginning to pile up on the unrealized side of the book. It's getting a little nerve-wracking. The stories are starting to show up on the front page of Bloomberg. Everyone thinks the Fed's going to be able to cut, but they even said, we don't think we're going to do that much. And now inflation might be picking up just a little bit. This is a real pickle. If you think we're out of the woods yet, you haven't been paying attention. You got your head in the sand. If you're one of those people who's like, what does this matter? I just want to make money. Well, then why don't you just long big tech and stop listening to my channel? Yeah, long Bitcoin and big tech, close your eyes, shut down TradingView, unsubscribe from my channel, and go about your life. But if you actually want to think about where we're going and what's happening in the world around you and not just, how can I make some money? There are very serious concerns about this cycle that, based on what has happened in the past historically and based on the mandates of the Fed, put them in a box. And we've talked on here quite a bit about how it is possible that we are at the end of the zero interest rate phenomenon. Because these are interest rates, right? Going back 150 fucking years. And we just spent the better part of a decade and a half at the zero bound. There is nowhere for them to go. We just accumulated a bunch of debt down here. And the only way for that debt not to cost more money is for the rates to go back down there or go lower. Because every time in the past, for the last 40 years, every time we've bailed out the economy, we have done it by pushing rates below where they were before. That avenue is now closed. Negative interest rates are not the salvation here. Rates cannot go below zero. Not for the global reserve issuer. What, are you going to tax borrowers when you need them to fund your deficits? No. This is a real pickle. And I think that this decade will be one that people will write many, many books about. All right. That's my monologue. That's my monologue for today. I was going to talk about Bitcoin on chain. You know, I'm going to do it. I'm going to do it. I was going to bring up something about Bitcoin. Okay. And I know I'm jumping around here, but that's what you signed up for when you subscribed here. All right. We look at Bitcoin, we look at macro, we talk Fed, we also look at Bitcoin on chain, we do technical analysis, we do sentiment analysis, we cover it all. So if you just want to talk about one thing, sorry. We're going to go look at Bitcoin on chain real quick because we are at this point. I've already gone through the technicals, right? Bitcoin's at its retracements, scary level. Don't really know if it's going to go anywhere any higher than that. We've got the indexes at all these big, scary, huge Fibonacci extension levels, kind of all around the same time. We got Dow and Nasdaq looking like this. Holy shit. But also something else that I think is just kind of interesting, and it's just a dynamic that I'm going to keep an eye on. It doesn't mean something yet, but it's something that I'm watching, is that I've been asked, where are the ETFs getting the supply for all these Bitcoin ETFs? Where are the ETFs getting the supply of Bitcoin for all the purchases, right? How are their providers sourcing all of this BTC? Where's it coming from? Well, some of it's coming from Grayscale. We know that because if we look at Grayscale's holdings here right before the ETFs launched, they had 619,000 Bitcoin, and now they have 462,000 Bitcoin. And when you do a little bit of math, you come up with about 158,000 BTC, right, that have left Grayscale. Well, if we look at long-term holder spending, these are entities who have Bitcoin, who have held it for at least 5 months or longer. Most of them have had it for years with an S on the end of it. They have been spending their Bitcoin. And this is something that the reason I point this out is not to be a curmudgeon, not to be scary. Again, it's just data, guys. Like, take the emotion out of it. The reason I point this out is because there are a lot of narratives about how the hodlers aren't going to sell, about who's selling to the ETFs here, right? They're going to have to fight for the last Bitcoin. The halving is coming, and that's going to cut the available supply in half. And so the ETFs are going to have to fight over even fewer coins. Right? That's all the things people say. But the hodlers, as they always do, are providing supply. In every market, in every single cycle, the hodlers provide supply at new prices. When the market regains its strength and it begins to show bullishness and animal spirits appear to have returned, there are people who hold Bitcoin for various amounts of time, and they spend it in those moments. They transfer it to another holder to do whatever it is that they like to do with it. That happens in retraces and in bull markets. In bull runs, when we break above the prior all-time high, that's when you see the most spending out of long-term holders. They provide the old coins to the new hands. That transfer of ownership is a fundamental component to a healthy market. It is core. It is a tectonic plate in the foundation of a market. Is old supply going to new holders? So all this idea about people never selling their Bitcoin, that is an individual story. That is a single person telling you a story about themselves. They are not telling you a story about the market itself. Now, you can look at things that show the amount of supply that hasn't moved in a year, and it's continuing to climb slowly over time. And that makes sense because you have the supply continuing to rise over time, and not all of it gets spent. Some of it gets held, some of it gets lost. And it doesn't need to all be spent to be relevant. But what is important is that just because it's been a long time since it has been spent doesn't mean that it is locked in concrete. It can come to life again. We see it happen. We see it happen to supply that is multiple years old, 2, 3, 4, 5, 6 years old. Once you get past 7 or 8 years, the chance that supply gets spent drops a lot. There's multitudes of reasons for that. But still, some supply moves. And right now, supply is moving. If we zoom in on this, this is about, I looked at the amount of supply that left long-term holders, and it's about 300, 320,000 BTC, depending on where you mark where it started. And what did I say Grayscale had lost? About 160,000 Bitcoin. I'm rounding up. So if long-term holders have spent 320,000 Bitcoin and Grayscale has been 160,000 of it, that's another 160,000 BTC that has come from somebody else. It has come from other unknown hodlers, other pools of supply. So just because Bitcoin has 21 million hard cap 100 years from now, it doesn't mean that there is not an availability of existing supply to service demand if the price is right. There will always be supply at the right price. That price might be higher, sometimes it may be lower, but what it is not is a number infinitely higher than where we are today. It just has to be incrementally higher, and then you start to see supply unlock. And we are seeing that now. Long-term holders are distributing into strength, not at the levels that we've seen in the past, but they are distributing. They have begun that process, and we're not yet to all-time highs. The timing of this is about on par with the last cycle, so it doesn't look weird yet. It's natural, though, and it's important to know that if you're someone who finds Bitcoin interesting and you have any intention of talking about supply dynamics and hodlers with people, it is important to be informed. And that is the truth of it. They are spending into strength, and only about half of it is grayscale. The other half is other hodlers, and who knows who they are. They could be anyone around the world. All right. I'm going to scroll back. Thank you so much for hanging out with me, guys. Got 240 of you watching. I'm going to catch up with the chat. You've been very patient. This has been an hour-long monologue. I'm going to catch up with all the questions and the super chats and all those wonderful things. Brandon Hammond gifting a membership. Thank you, bro. That was the very beginning of the stream. So did Stephen Edinburgh gifted a membership. Thank you, guys. Very generous. What's up, y'all? General Jackass, welcome. Miles, what'd Miles say? I see Miles had a donation with a question. Miles donated and said, BCB got me into your streams. I really love your methodical dissection of the market and sentiment. Thank you so much. That's really generous, Miles. Thank you, bro. And Chris says, what up, TXMC? Hope you're doing well. I am doing excellent. Thank you for being here, Chris. Thanks for gifting a membership also. Very generous, bro. If you're looking in the chat and you see these green names, you're wondering what that's about. Those folks have gone an extra step. They've very generously either been gifted or decided to create themselves and join the channel memberships, which gives you access to a private stream that we've been doing once a month. We've done 2 of them so far. We'll do another one in a couple of weeks. It's just a way to show some extra love to the channel. It's certainly not necessary. We'll continue doing these public streams, but if you choose to take that extra step, I greatly appreciate it. I will recognize you, and then you'll have access to the private streams. Oscar Dono with the 199, with the arrow pointing up, saying, at Wealth Trader, who says, hit the like. Hit the likes. All right, let's see. Let's see if there's any good questions in the chat here. Let's see you guys. See, BCB was here earlier. What's up, BCB? I didn't even look at the chat. When I get in my mode, when I get in my flow state talking, I don't look at the chat very much. Full honesty. I go back and look at it. Like right now I'm looking at it. But in the moment I don't look at it. I have to go back and catch up, because if I get disrupted, I'll forget what I was talking about. And so I kind of just stare at my own screen. Sometimes I just close my eyes and I try to get through everything I was thinking about. It's like a floodgate whenever I open it up, and it just blah, stuff just comes out. BCB said something earlier. I embrace it. The crowd wants what the crowd wants. Yeah. Twitter is euphoric. They absolutely are. I think it's crazy that people think that there is no sentiment here, that there is no retail, that there is no excitement, when A, the ETFs are buying $400 and $500 million a day of Bitcoin. Who's buying it if it's not retail? And secondly, there's a lot of people tweeting things like, oh my God, it's 50K and no one's talking about Bitcoin. Oh my God, can you believe how not bullish everybody is? Or, oh my gosh, everybody is still sidelined. Like I saw one of my buddies tweet, and he got like 3,000 likes for saying that. That's not what happens when there's nobody here. Have you guys forgotten how bullish everybody was 1 month ago, before the ETF launched? How insane it was. Eric Balchunas and James Seifert from Bloomberg were like doing Twitter spaces with 2,000 people in them. Y'all don't think anyone's paying attention to this? The ETFs are on fucking Squawk Box every day. Joe Kernan's talking about it. No one's paying attention? I thought the media machine had kicked into high gear. I thought all the advertising. Like, we can't have it both ways. Either the advertising is running full steam and they're buying 500 million Bitcoin a day because everyone wants to be in this asset, or nobody's here, in which case no one should be liking your tweets. So there's definitely people watching. I think what warps people's perception is just how crazy 2021 was. 2021 was the it was the way the middle impulse of an absolute maniacal bubble. That was true peak mania at a secular level, at like a long-term bubble level. 2021 was the peak, right? We had meme stock mania, GMC mania. We had SPAC bubble mania. We had ARK bubble mania. We had Bitcoin bubble mania. We had the cryptos going insane, things doing 100x's to 9-figure valuations and 10-figure valuations like overnight, 11-figure valuations. And luxury goods skyrocketing, right? People paying out the ass for travel. All kinds of collectibles being extremely hard to find. Like that was absolute insanity bubble peak. And I think people are expecting us to go right back to that. But what I keep saying is it's not going to be exactly like that again. I think we can generate traces of that, and we're seeing elements of it. But that was an exhaustive bubble peak. And even though we've made new highs here, this is almost like the expanded flat, retracement move that makes a new high on the big bubble mania that we just had 3 years ago. We had just sent trillions of dollars to people and rained it down upon them and asked for nothing in return. That broad-based mania that was everywhere, where we had Reese Witherspoon tweeting about Ethereum at the literal top, like that, to expect that to come right back just because it's bull market again is not reasonable. And I think that has warped a lot of people's ideas about what sentiment is supposed to look like as you approach the top. Like it should look somewhat like that, but to expect exactly that again, that level of interest, I don't think you're going to get that. I think it exhausted a lot of people. We destroyed a lot of wealth, and there are still a lot of animal spirits from the people still in this market, but some have left and they're never coming back. And that mania, it will not be reached again because many of those assets that were at those highs are nowhere near them anymore. Like look at ARK. So here's ARK. Everything was up here, right? A lot of stuff is now down here. So you can't expect everything to look the way it did back here again, just because it's a bull market. Brandon said earlier, Lynn Alden predicts no recession or soft landing. She calls it a sector-specific recession. Companies tied to interest rates will experience it. Yeah, I mean, it's one idea. It's one idea. The rolling recession idea that feels a lot like it'll be a recession, but it won't feel like it, which doesn't really make sense. I love Lynn. She's great. She's real smart. And I've learned a lot about just kind of financial history and plumbing and stuff from her. But I don't know that I agree about that particular thesis there. Does it matter that NDQ is measured from the 2000 bubble, but DJI is measured from 2008? Crypto Hammer asks. No, it doesn't matter, but it makes it more fascinating, right? You have to measure the chart relative to itself, right? And this was the bubble peak for the Nasdaq. It wasn't the great financial crisis, but on the Dow Jones, it was. So like this was a tech bubble. This was a, debt deflation where we had value stocks actually doing pretty well as some tech, but tech was still broadly recovering from a massive crash years earlier. But you measure the charts relative to themselves when you're using these fibs and things like that. You don't just place them in some arbitrary place because it's like that on another chart. But what's fascinating is that the Dow Jones is now at that level from a completely different point of time and a completely different amount of percentage gains to the Nasdaq, which did it from much further ago in the past and had to go a lot higher in percentage terms. And it's right there. It's crazy to me. I can, please look, Metal Ants says, look at the FTSE UK 100. Okay. I've traded this a little bit. I've looked at the FTSE some. Yeah, so I'm not an expert on the UK stock market, so I'm not going to be able to provide you a lot of like alpha on this. This is just a hideous chart. Like, why would you own any of this stuff? Maybe there's a lot of dividends in this market here, and so it's a little different. It's not just about the valuations, but I just don't know what to make of this. I think it's really interesting that you have the UK probably in recession, or at least very close to it, and their market is right here. You have Germany in a technical recession and their stock market is at all-time highs. You have France basically entering into a recession also, and their stock market is at all-time highs. And then, you know, you look at China, it's in a recession and it's at all-time lows. Europe is very tied to the US, you know, economically and policy-wise, and the way that they structure their economies. China is the polar opposite. So I think part of what's going on in Europe is reflective of what's happening here in the US. Could I explain what happened to the NFP data being seasonally adjusted? Oh, Oscar asked that. Yeah, sure, Oscar. I'll go show you that. So I tweeted this a couple days ago. This is related to the non-farm payrolls number that came out. Media. Where is it? Here. Yeah. So here we go. Said the nation did not add 353,000 jobs in January. It actually shed 2.6 million jobs, but seasonal adjustments wash out the real figure for a fake pseudo moving average. The same thing happens every January. So I tweeted this because when you get the job number and you see the report and it says, oh my God, the US added 353,000 jobs. It is reporting the month over month change in non-farm payrolls, the red line, which is seasonally adjusted. And it has some assumptions built into it because the real number, the actual number, is the blue line, and it chops around a whole lot. If you just look at data, if you're someone who looks at economic data very regularly, you see this all the time. The non-seasonally adjusted stuff's just a lot choppier because there's seasonality. That's what seasonal adjustments are for. They are to clear some of that stuff out. So when you look at actual employment, this is what it really does. And every January, it falls because businesses shed a bunch of seasonal workers. People make changes because it's the beginning of the year. Some businesses just let people go because they do yearly reviews, right? There's a bunch of things change at the start of the year. And you always get this dip. You also tend to get a dip in the middle of the summer. It's just really consistent. It's because of the way certain sectors and certain, just behaviors play out in the marketplace. And seasonal adjustments try to ignore all that and just come up with a number for you to look at that like splits it down the middle. And when you look at them together, the seasonal adjustment looks like a moving average. It's just right through the middle of what's actually happening. So when they say the US added 353,000 jobs, that number is bullshit. It's completely made up. It's just the moving average middle split of the last few months of data and based on some seasonal factors that use the last couple of years of data. But the real change was 2 million less people had jobs. And it happens every January. And my point in bringing it up was not to say that that's our first negative NFP print. That's not what it means. Every January is a negative NFP print. My point is that the month-over-month change in the seasonal adjustment that you hear about in the news, that number is bullshit. And it's not real. It's probably a number much lower than that. It's not 353,000 jobs were added. That's just some guess based on, again, some moving averages. And if you look at employment level, which is the other survey of labor, right? We have the non-farm payrolls number that we were just looking at that comes from the establishment survey where they ask businesses. And then you have employment level, which comes from the household survey, which is called the current population survey. That number is much more volatile. And over the last few months, it has had some negatives in there on a seasonally adjusted basis. This is the other measure of employment. So while non-farm payrolls, over the last year, if I show it to you, show the change, it's been all positive. All these numbers are above zero. The household one has actually dipped below zero sometimes. It's more representative of what's really happening, but you can't just take it for itself. You kind of need to blend them together. And so when we look together at the economy, when we use my dashboards and we look at the economy, we look at a blend of both of them together. I average the two together and we look at what's called employment composite. And that gives us a much better, clearer picture of what the two are saying. Where's Enron? Yeah. Checkmate says, if Bitcoin reaches the previous all-time high in the next few months, would your thesis change? It's a fair question. It's not going to be just a price that changes everything for me. If Bitcoin gets above all of its retracements, if it gets above the 786 and it starts marching towards the all-time highs, well, I was wrong about Bitcoin. But that doesn't change the recession idea or what's happening in equities. And I would assume that if Bitcoin is up here and clearly above all this, I would assume also that equities are way up here and they're they've just said, fuck you. And they've completely ignored all this. I would assume that would be the case. And so if that's the case, then yeah, we would have to second guess ourselves about the market. But I think it's really vital that I make this point. And that is there are two different ideas about what we think is going to happen. One of them is a recession thesis that doesn't include any market data. It only includes economic data. We look at the labor market, we look at incomes, we look at spending, all that kind of stuff, right? The cyclical pieces of the economy. And we have an idea about what we think will happen there based on analysis in that realm. And then we also have an idea on a technical basis about the markets themselves. And it just happens to be aligning at the same time as the economic thesis. So they just happen to be occurring at once. But one doesn't invalidate the other one necessarily. One could cause the other to play out. So they have to both be nullified for us to completely wipe our brow clean and say everything is great. We would need to see equities blow out all the 4.236 extensions, Bitcoin above its at its all-time high or going higher, and all this stuff about the economy, recession, the rates of change of credit, the rate of change of labor, which, oh, by the way, continues slowing down in a very concerning fashion. All that stuff has to also turn higher, or at least appear to have stabilized in an area where we could say maybe it's going to hold here for a while and we can get a couple years away from this. So it's two different components. And that's part of the reason why it's so hard for me to tweet about what I think on Twitter, because I can't say all of that in a tweet. I can't constantly remind the audience on Twitter that we have a recession analysis and we have ideas about the technicals of the market, and they just happen to be aligning. And that's why it's so eerie, but they are separate. BCB says, hey, TXMC, I have a question for you. How many times has Bitcoin started a bull run when the Fed fund rate was above 0.25%? Well, it's funny you say that because I was looking at the Fed funds rate compared to the different epochs not that long ago. So let's go look at it real quick. Let's just look. I think I can do it on here. Fed funds rate. Yeah. Let's see if I can do it. That's not, yeah, that's an epoch. That's not a bull run. Okay. So let me see Bitcoin's price. Let me see if I can put BTC's price on here. Is it in here? Oh, no, it's not. I don't have Bitcoin in here, do I? I need to add Bitcoin to my table. That's one thing I really messed up on, was that I don't have BTC, the price in here inside this table. That's okay. That's okay. But you can see this is the Fed funds rate through the first 3 epochs of Bitcoin's life. See, here's 2009 when Bitcoin first began. And you can see how much of Bitcoin's life was at the zero bound for Fed funds. We had this one push up here, this 4th epoch. Oh, they're out of order. That's the right order. How much of Bitcoin's life we spent with interest rates at the zero bound? The only time it wasn't was right at the tail end of the bull run, right? Here's the tail end of the bull run in 2017, right here. But the market began back here, right? The low of the market was between 2015 and 2016 when rates were still down at that level. Here was the low of BTC in 2020. So, good point from the homie there. Can we check in with some of those metrics you laid out in your Recession Roundup series? Yes, we've looked at some of them as we've gone along, Vitruvian Boy. I didn't show them specifically today because I just had a lot of things to show. But I'll just do a quick touch on them. And it's not that. That's not the one. Let's find a different one to look at. Okay. This one? Yeah. Okay. Here's one of the ways to look at it. Composite growth is everything, all the metrics that we look at together. The reason we're in a difficult place to measure just those metrics is because we're now at the point of the cycle where in the past, recessions have begun by this point. So depending on the time anchor that we use, whether we use the yield curve inversion or the recession starting or the Fed tightening, all of those anchors lead us to a point now, 2 years into a Fed tightening, a year and a half into a yield curve inversion of the 3-month 10-year, deep into these processes where most recessions have begun at this point, or many have, some haven't. And so when you look at the composite of the growth rates of things like demand, of things like employment, of things like everything put together, the gray line in the background, which is the blend of the growth rates of all the prior cycles, they're all breaking down. But we still have strong demand growth, right? People are still spending money. Their incomes are continuing to grow. So demand is still kind of structurally rising from relatively low levels. Cyclical growth has picked up a bit from the lows, and it's above where things normally are at this point. But again, this is 12, 15 months into a yield curve inversion in some cases. 15 months and 13 months. But this is usually the time when the recession starts to happen. And so it gets really difficult trying to measure. But if we just look at Fed tightening, right? So which is one of the places where we have the most runway of comparisons still left. And we look at today versus, let me change the color on this. Let me change this to this. Yeah. Here's today. And this is the chart I just showed before was all the growth rates. Was all the growth rates from the time that the yield curve inverted. So let's change the anchor. Let's change the anchor to when the Fed starts tightening, because that happens in every cycle, whether there's a yield curve or not, yield curve inversion or not, and it tends to lead to the end of the cycle. So if we flip over and we look at the same composite growth, but we have it relative to months of Fed tightening, it paints a little bit of a different picture. We don't look like we are accelerating out of the doldrums like we do relative to the yield curve inversion. Relative to Fed tightening, cyclical growth is still below potential in what is normally a downtrend. Demand growth, which is personal consumption and real incomes, that is continuing to structurally build higher, but it's around the potential growth rate. So it's not an invalidation, doesn't look bad, doesn't look good. Employment looks worse. Relative to Fed tightenings, employment has slowed down on an average basis faster than in prior cycles. Credit just looks abysmal. I mean, look at that. That looks awful. And so from a composite basis, putting them all together, this is what we look like, this dark line relative to prior cycles at this depth of Fed tightening. And if you're wondering where the recessions are, this is the same view. I know I'm jumping to different charts. This chart is a bunch of different composite growth rates, right? Over here is employment relative to Fed tightening. So now I'm going to show you just employment relative to Fed tightening with all the eras broken out. That's over here. Here's our same black line. Here's all the eras broken out, which when combined made the gray line on the other chart. And down here is all of the recessions and when they started, when the first month of recession was recorded. Remember, that's not always when it is obvious. That is when they date it to have started in hindsight, and they do that like a year or two later. So just because the recession began in this month of 2007, 44 months after tightening began, it wasn't obvious then. People didn't even really know it was a recession for another 6 months. But here we are today. We are right here, 23 months into a Fed tightening. It is February 2024. Fed tightening began in March 2022, 23 months in. And from this moment in time, there are 1, 2, 3, 4, 5, 6 recessions still ahead that began at this point in time. So that is why we can't get ahead of ourselves with the economic data. And that's what makes all these technical things lining up even more butt clenching. Because labor, which is the most important part of the economy, is continuing to slow down. And it's still slowing. Where are my dashboards? It's still slowing in line with prior recessions and below the growth rate of 1966, which is our soft landing example. So, tough spot. Tough spot, ladies and gentlemen. Would it not be better for us to have a recession sooner rather than pushing it out later? Well, if it happens too soon and too quickly and it forces them to reverse policy, then we may not actually work through any of the problems. It almost needs to be a slow burn, or else the Fed will be forced to act a lot sooner and a lot more strongly than they really want to. And that's what they're trying to avoid. And that's just a really important point that I think it's overlooked. Is like we don't want to just hurry up and have it. Because if we get like a COVID style rug pull, then they're just going to kick the can. And we're not going to actually have like the virtuous outcomes that come from the end of a cycle that put us in a healthy place going forward. And so, from my perspective, I would like to not have that. I'd like to not have any negatives, but that's not possible. So I would like to have it happen slowly rather than all at once. Spicy TXMC. Yeah, I forget what I was saying earlier, but I was definitely getting spicy. Money's the reason everyone is here. Money is the reason TXMC has this channel, but it's good to learn things to make money. Yeah, absolutely right. Like, everyone wants to make money. And if you're in the markets, you do want to make money. But dismissing every conversation with a hand wave and saying, yeah, but what's the trade here? It's just annoying. It means we can never have adult conversations about anything unless we tie it to a trade. Everything has to be tied to a trade. And if that's how you operate, that's totally fine. I just don't find that very interesting. Like, I like trading. I do it. I love trading. But I also really enjoy studying markets and the economy. And those things are interesting. And it is possible to separate out the technicals from all of the other context. And I think it just makes you a more powerful analyst, in my opinion. If you're able to separate them, look at them individually on their own merits, and then marry them together into something more cohesive. That's what I think people should do. And maybe not everyone wants to do that. That's cool. Maybe should is not the right word. That's how I like to do it. And so that's the way I'm going to do it. And if you're here, that's what you're signing up for. Brandon donated and said, "Can you answer my question about Lynn Alden?" I hope I did, bro. I think I answered you earlier, Brandon. Let me know if I didn't. Andy Philpott with the gifted membership. Thank you, bro. Welcome, Oscar Santana. You just got gifted a membership from Andy. Next time we do a member stream, you'll be able to be there. Brian Cole says, "What assets are you looking at given a collapse occurs?" That one is hard. I was working on making a sector analysis for us. I just I don't have it ready to go. It depends on what your priorities are. If you're someone who wants to stay long the market, there are not very many places to hide in a recession, in a liquidity grab, in a cash grab, right? In like a stage 3 downturn, like, whatever things people call it. There's not a lot of places to hide if you want to stay long. There are places where you can mitigate the loss, like hard assets, gold. Some people think Bitcoin will be that, but I think it is still much more tied to risk. And so it's unlikely to be that. I'd have to see it to believe it, kind of thing. But we'll maybe get into that at a future date. I want to do a better job of really looking into all those things. I don't want to give you bad information. But if you're a long only investor, a buy and hold investor, there aren't that many places to hide other than cash. And, you don't want to just go to cash early and miss out on gains unless that fits with your risk parameters, depending on how much you have at stake and how important it is that you not lose that. You need to be able to sleep at night. So what I think might not matter for you. I hope that I can give you things to think about, but I should not be providing a prescription for anyone except for myself. BCB, every all-time high breakout was at 0 or near 0 rates. Yep. Brandon says, "I'm currently at the gym blasting biceps while listening to TX. It is not motivating me." That's pretty funny. Just looking at the chat here. TXMC a little spicy here. Yeah, got a little spicy. I'm going to have to go back and see what all I said. So, Brandon, are you talking about... I've caught up with the chat now. Brandon, are you talking about your question related to the rolling recessions? If I recall what I said, I think I said that I just... That's just not how I see it. I know that from what I understand, her analogy, I don't want to talk about Lynn Alden's analysis when she's not here to give it better context, because I'm not going to represent it as well as she could, certainly. But my understanding is that her perspective, sector-specific recessions, rolling recession. My perspective is that she thinks that we are in line for some kind of an emerging market style recession where the government is forced to run massive deficits because of inflation, and it keeps asset prices up while inflation crushes, the middle class, and affordability really suffers and growth suffers. And maybe that happens. And in certain ways, we've seen hints of that. But what it's hard for me to accept is that what we're seeing right now in certain tech-related sectors, which is currently the only place that's really performing the way that it is, that's somehow going to continue while all the other sectors that have been interest rate sensitive and have been underperforming, they just continue underperforming. We just have this like massive gap. Like what's going to cause the rotation? And if we have a rotation, big tech is 40% of the S&P, right? Like the biggest stocks are 40% of the S&P. So if they're going to underperform, what's that going to do to the index? The math just doesn't add up for me. So I think it's an interesting thing to think about, but I don't know how applicable it is to the US markets or the fact that they're the global reserve issuer and the comparison to emerging market recessions. I hope I gave you a better answer. I just don't know if that's realistic. I think it's like an interesting mental exercise more than I think it's the likely outcome. Andy Philpott just raining the memberships down. You're such a boss, dude. Thank you. Thank you so much, Andy. When in 24 do you think the shit will hit the fan with the corporate debt refinancing stuff? General, that's hard to answer. I think part of it has to do with market expectations around interest rate cuts. And we're still at a place where expectations are slowly being repriced. Like we talked about earlier, and we looked at the FedWatch tool, right? And we noticed that probabilities have come down, but they're still higher than they should have been until very recently, until like 48 hours ago. People still didn't believe the Fed about March. And if you look at this still shows 6 cuts in 2024. They still don't believe the Fed about interest rates. And so I think that there is still a holding on, a clenching of butts in the market broadly. And I could show you a bunch of news stories, but I don't have them pulled up here, so I don't want to waste your time. But I just keep coming back to this chart over and over again. I keep coming back to this. I don't know when it starts. The maturity wall is a few years long. It starts in 24, 25, 26. I think it comes down to expectations and whether or not businesses think they can continue to hold out for something that they are repeatedly being shown is not likely. No one wants to be the person who starts price discovery in an illiquid market. Think about it. If you've got a bunch of commercial property and it's not being traded, then there's no price discovery, right? No one really knows what the markdowns are. Everyone's kind of waiting, holding out hope, clutching to their old valuations from a couple of years ago and not wanting to find out the truth. But slowly over time, as certain entities are forced to liquefy assets to get capital, either to return money to their investors or to pay other loans, they will be forced to take assets to market and find out what those things are worth. And where did I tweet? Here we go. I tweeted something the other day. I'm going to find it for you guys. Where I tweeted about the valuations. I can't find it now. I sent a tweet like a couple of weeks ago where it was about all of the haircuts that we were seeing in property values, and they were just getting slashed. And I was seeing haircuts of like 50, 60%. Yeah. Here we go. Just look at some of these recent haircuts on office properties. Some of them, I'll read the first tweet. The first tweet I sent, this is a slow-moving global train wreck, and all the classic signs are there for a bust. Banks have been playing accounting games, delaying the mark-to-market reality that could upend their balance sheets. They're trying to hold to maturity properties that won't pay off at maturity. Recent deals saw 40 to 60% haircuts on 10-year-old valuations. Price discovery is coming. Right, remember, I was just describing no one wants to be the first person to knock down the domino, right? Everyone's holding still. It's a Mexican standoff. Just look at some of these recent haircuts. Some of them are 50% from valuations that are a decade old. The appraiser priced this Fifth Avenue property in Manhattan at $84 million, 53% below its 2014 value. Wall Street securities firm Evercore reported an implied value for a midtown Manhattan complex at $1.2 billion, down nearly a third from 2017. A 26-story tower between 55th and 56th Streets was appraised at $175 million in April, down 71% from its 2014 value. 4 Brooklyn office buildings lost 68% of their value since 2018. There's a website that I subscribe to called therealdeal.com, and it's a bunch of real estate news. Like, that's where I got half these stories from. And you're starting to see these, right? They're starting to trickle out. And you're seeing these stories appearing on the front page of Bloomberg. Banks having to add hundreds of millions in provisions for potential loan losses, and they're appearing on the earnings reports. They appeared in the earnings reports here just a couple of weeks ago. This is a slow-moving train wreck. And over the course of this year, I expect we will uncover many more cockroaches underneath these rocks. And just don't forget, it's not just me that thinks this. It's Lacey Hunt. I played this clip for y'all a couple of streams ago. I'm not going to play it again. Lacey Hunt agreed with everything that I think about the credit markets. And that just makes me more nervous. That doesn't make me feel better. Makes me feel good as an analyst, but makes me feel worse as a market participant. So I've caught up with all of your questions. If you still haven't hit the like button, smash the like. Don't make me ask again. This has been a banger stream. If you've missed this, I think you need to go back and watch it again. We dropped so much alpha today, I'm going to have to go take a cold shower. I am open. General Jackass, can TXMC members get an emoji that has 10 microphones and 5 monitors? So I've been trying to come up with ideas for emojis. I've got someone on the hook who can help make a couple of them, but I don't have any ideas. So I'm open to ideas on that. I really don't know. We have a couple. We have the soup can. We have the Bitcoin coin. But I want to come up with like maybe 3 to 5 more of them to start with. For you guys that are like related to the channel that are kind of funny. And I just don't have good ideas. So that's why they haven't come yet. But you mentioned it, so I thought I'd bring it up. Michael McFarland says, TXMC, the book you recommended, The Price of Time, is fucking lit. Yes! Yes! Michael McFarland, that book is so good. I'm telling you guys, read this book. I'll be happy to read more pieces of it. If you guys want, maybe we can do a member stream where we read some sections of it or something, or we can do a whole public stream. I mean, I don't really care, but get this. If you want to find something cool to read that is written in real English, and it's not a bunch of wonky talk. There's some wonky talk, but it's mostly in real English. And it is a history of monetary policy and interest rates over the last few hundred years and why it actually is relevant. Read this fucking book. I read it last year. I have posted probably a dozen huge excerpts on my Twitter page from this book. Big chunks of them. I've read them here on the stream. I loved it. Now, I've read a lot of other books too, and I could tell you about other ones, but I'm stuck on this one because it was just written in 2022. It's very timely. It not only explains current monetary policy and why interest rates are why they matter and why this is an interesting place for rates, but also it explains the rise of China. It really gives you an inside baseball look at how China developed over the last 25 years, and that has been invaluable for me. So that's enough of my praise. I don't know Ed Chancellor. I didn't get paid to make a testimonial. I just loved the book, and I recommend that you read it. I prefer The Wheel of Time. That's a based answer, Brandon Hammond. You know, if George R.R. Martin dies before he finishes writing A Song of Ice and Fire, I really hope they get Brandon Sanderson to finish the series, because he finished Wheel of Time for Robert Jordan after Robert Jordan died, and the fans loved it. Wheel of Time is like a 13, 14 book epic, and Robert Jordan died like 9 or 10 books into the series. I know those numbers are wrong. Someone will correct me. And Brandon Sanderson, who is another fantasy author, got hired to finish the series, and he blew it out of the fucking water. He writes his own books. He's amazing at it. The Stormlight Archive is an incredible fantasy series that he is currently writing that I highly recommend. And if George R.R. Martin's fat, stupid ass dies before he finishes The Winds of Winter and The Dream of Spring, which is increasingly likely as time goes by, then I really hope Brandon Sanderson finishes it. If you want a cool ass fantasy story to start, and you haven't read, and you've already read A Song of Ice and Fire, which is the Game of Thrones books, maybe you've read the Kingkiller Chronicles from Patrick Rothfuss, which is The Name of the Wind, also really cool, but there's only 2 of them. This book, The Way of Kings, is the first book of a series called the Stormlight Archive. And It's written by the guy, Brandon Sanderson, that I'm talking about, the guy who finished the Wheel of Time series. And it's book 1 of the Stormlight Archive. And it's so fucking cool. It is so cool. All right. That's a little my nerdiness came out at the end. Yeah, if you have any questions for me, make sure you leave them in the comments to the video or throw them in at the end of the chat here. I might see them before the end of the stream, but if the stream is over, I won't see them. You should put them in the comments to the video. We will do another live stream a week from now. I will do one next week. I won't skip. I just skipped last week. And that's where we'll leave it. This is an interesting place for the market. I'm not getting ahead of myself, but Bitcoin is at the retracements. Equities are at their 4.236 extensions all at the same time. And we have a recession thesis. So my butt is fully clenched. I got a hand on each cheek. I'm holding on for dear life. I'm not scared, just very nervous. We are prepared. I am long Bitcoin still. I have some left. I sold my traded account Bitcoin. I still have my HODL stack. Got a bunch of altcoins. I'm waiting to see if they push up on a retracement move. If they don't, I'll have to de-risk them at lower prices than I wanted to. I have shorts on big tech, hoping they pay out by the end of the year, but I will be ecstatic if they expire worthless, because it means everything else will have gone up. And that is what we will do. We will watch, we will observe, we will continue to ignore the fuckboys on Twitter who just think in narratives, and we will stay tethered to our data and our analysis. We do need Ethereum to move. That is correct, Fabio. We'll look at some of that stuff next time. We just had a lot to talk about here after skipping the week. Had a lot of things to say. Don't want to go 2 hours, so we're going to wrap it up here. Thank you for being here. Thank you for supporting the channel. Appreciate to Brandon Hammond, to Andy Philpott. Who else gave out frickin' memberships today? No, my screen just froze up on me, so I can't see. If you gifted a membership and I didn't say your name, I'm sorry. It's not showing it to me. Thank you for doing that. Very generous. Eric Martinson gifted a membership. And we will bring this back here a week from now. This has not been financial advice. Make sure you do your own research, but I am grateful to be a part of your research. I don't have a book list anywhere, Jacob, but we could talk about it some more later. Data visuals, I learned how to do myself. I don't have a book on that. Thank you so much, everybody. I love you guys. 6-7 days from now, we'll meet again and we'll do it all over again. Let's hope that I'm wrong and that Bitcoin is at 70K next time we meet. So until then, take care of yourselves, friends. Take care of each other. Enjoy this beautiful winter into spring weather. And we will meet. Some of you might not be having beautiful weather. I am. And we will meet again in a few days. Thank you, everyone. Cheers.